Hey everyone, welcome back. Today we're going to dive into the world of crypto.
Yeah, crypto arbitrage. I saw this term floating around and I was like, what is that arbitrage? And you've given me some really interesting material to dig into, so I'm excited to get your take on it too.
Yeah, I'm happy to break it all down. Arbitrage, it sounds kind of like magic, right? Like risk-free profits. That's what everyone's after.
Yeah, you had me at risk-free, but I'm guessing it's probably not as simple as it sounds.
Yeah, you're absolutely right. There's definitely more to it than meets the eye.
Okay, well, for our listeners who maybe haven't encountered this term before, how would you, like just in a nutshell, explain what crypto arbitrage is all about?
Sure, so at its core, arbitrage is about taking advantage of price differences for the same asset, but across different markets.
Okay, so like if I'm thinking about like the real world kind of, does that mean like, I don't know, finding some rare like antique or something at a flea market and
Uh-huh.
then selling it on eBay for like way more? Yeah, that's actually a great analogy. You're essentially exploiting the fact that one market hasn't caught up to the value that another market recognizes.
Okay.
Now, in the crypto world, imagine Bitcoin, for example. It might be trading for slightly different prices on different exchanges, right?
Right, right.
So an arbitrager, that's what we call someone who does this, would buy Bitcoin on the exchange where it's cheaper and simultaneously sell it on the exchange where it's more expensive.
Ooh, so it's all about being quick, like really, really quick.
Exactly. You got to be fast on the draw. And that makes me wonder, like, are we talking about people like frantically clicking around on their computers, or is this all like automated somehow?
Well, in the early days of crypto, manual arbitrage, like, someone actually doing it themselves,
Mhm.
was a bit more feasible because things were slower, less competitive.
Mm.
But as the market matured, that window of opportunity, it shrank dramatically.
Yeah.
So today, it's really dominated by algorithms
Yeah.
and high-frequency trading.
Mm.
We're talking trades being executed in milliseconds.
Yeah.
Wow. So those movie scenes where you see someone like on the phone yelling, buy, buy, buy,
Yeah.
like that's not really how this works anymore.
Not quite. It's more like imagine powerful computers constantly scanning exchanges all over the world, detecting these tiny price discrepancies, and then boom, executing trades before, a human could even blink.
Got it. So when I was looking through the stuff you sent me, I saw it's not even just about like the simple buy low, sell high between exchanges, right?
Yeah.
There was something about triangular
Oh,
arbitrage.
yeah, you're digging deep. So you're right. There are different types of arbitrage. Triangular arbitrage, that's where it gets a little more complex. It involves exploiting price differences between three or more assets. Often it involves converting currencies.
Okay.
So, like, imagine converting dollars to Bitcoin, then Bitcoin to Ethereum, and then finally Ethereum back to dollars,
Well,
all at slightly advantageous rates along the way, hoping to end up with more dollars than you started with.
so that sounds like you really need to know, like what's going on. Like you need to have a good grasp of what all those things are worth.
Yeah, you need a good understanding of market dynamics, the ability to calculate those conversions, quickly and accurately.
Yeah. And then there was, what was it? Statistical arbitrage?
Ah, yeah. That's where it gets even more complex. Statistical arbitrage relies on identifying mispricings, but based on historical data.
Okay.
And then you use like super sophisticated algorithms
Yeah.
to predict future price movements.
So it's less about seeing a difference right now and more about kind of guessing or using data to see where prices might go.
Exactly. It's like trying to, predict the future of the market, which of course comes with its own set of risks.
So this whole idea of arbitrage being risk-free, maybe not so much.
Yeah, that's a big misconception. People hear arbitrage and they think free money, but there are definitely risks involved.
What kind of risk?
Well, one of the big ones is something called slippage, which is basically where the price moves against you before you can complete the trade. So you think you're getting a good deal, but then suddenly the price changes and you end up losing money. And then there are exchange fees. You have to factor those in.
Right.
Trading bots, even the most sophisticated ones can sometimes malfunction. And then there's always the risk of like regulatory changes.
Oh, yeah. Like the government steps in and changes the rules.
Exactly. So it's definitely not a set it and forget it kind of strategy.
So, okay. So risk-free maybe is not the right word. It's more like lower risk if
Yeah.
what you're doing.
Yeah, exactly. Lower risk maybe if you're a pro.
Okay. So speaking of pros,
Yeah.
like this all sounds so complex to me. Is this something that a regular person like can actually do? Or is this like for big institutions with, tons of computing power?
That's a great question, and it's true. I mean, the barriers to entry for arbitrage, they are pretty high, especially for those more complex types like the statistical arbitrage we talked about. Yeah. But, there are some platforms starting to pop up that are trying to make it more accessible to, everyday investors. They often do this by like pooling resources together or by providing, simpler interfaces that are easier to use.
Interesting.
Yeah. It'll be interesting to see how that all plays out, but it's definitely a space to watch.
Yeah. So we've talked about like the different types of arbitrage, how technology plays a role,
Yeah.
and the risks.
Yeah.
But I'm still kind of wondering, like, does this actually work in practice? Like, are there examples of people
Yeah.
actually successfully doing this?
Oh, absolutely. There are tons of examples. One that comes to mind, and this was a while back, was a group of traders who exploited a price difference for Bitcoin between a US-based exchange and an exchange in Korea. They used algorithms to spot the difference, executed a bunch of trades, and, made a good chunk of profit in a very short time.
Interesting.
Yeah, it's just that these stories don't always make headlines because, arbitrage can be seen as like the less glamorous side of crypto.
Right. Yeah. It's not as exciting as like, investing in the next Dogecoin or whatever.
Yeah, exactly. But it is a strategy, though, that's been around for centuries, various forms, so it's definitely got staying power.
Okay. Yeah, I think a key takeaway here is that
Right.
while crypto arbitrage can be, potentially profitable, it's not some get-rich-quick scheme.
Absolutely not. It requires knowledge, careful planning,
Yeah.
and you really need to understand the risks.
Yep, totally agree with that. So as we wrap up our deep dive here, I mean, it really leaves us with a lot to think about, right?
It does. Yeah.
Like, will arbitrage ever become something that, anyone can do easily? Or will it always be dominated by, the people who have all the resources, all the computing power?
Yeah, that's the big question. I don't have a crystal ball, so I can't say for sure. But I
Okay.
think it'll be really fascinating to see how this all unfolds. The crypto landscape is always changing.
It really is.
So who knows? Maybe we'll be having a completely different conversation about this a year or two from now.
Maybe. Well, until then, thanks so much for joining us on this exploration of crypto arbitrage. Really appreciate it.
My pleasure. Always happy to talk about crypto, even the less glamorous parts.
Well, you made it glamorous. Until next time, everyone.